Hello, everyone. Welcome to the Capital Intelligence channel. Today, we're undertaking a real forensic analysis of the stock market's conflicting signals. Because, on one hand, we're witnessing this absolutely incredible AI-driven tech boom that's just pushing indices to record highs. But on the other hand, we've got multiple historically accurate warning signals flashing bright red right beneath the surface. So we're going to unpack exactly what the data is telling us and deliver high-value insights for people who are truly serious about finance and investing.
Okay, let's dive into this. When you check the major indices right now, honestly, everything looks fantastic. But as serious investors, we really have to ask the hard questions. Like, are these record market highs actually hiding deep structural instability? Is the sheer gravity of the so-called Magnificent Seven stocks, your Apples, Microsofts, and Nvidias, just creating this beautiful facade over a fundamentally fragile market? Here's our roadmap for today's explainer. We'll be looking at 1. The illusion of market highs. 2. The great market narrowing. 3. Warning signals flashing red. 4. Dot-com bubble comparisons. 5. The Fed put factor. And 6. Positioning in concentrated markets. We are going to methodically weigh the bullish fundamentals right against the macroeconomic warnings.
Number 1. The illusion of market highs. Look, we are living through the AI revolution right now, and the sheer amount of capital being deployed into tech is, frankly, historic. But we always have to remember that legendary contrarian quote from Warren Buffett, right? Be fearful when others are greedy, and be greedy when others are fearful. Because right now, sentiment trackers like the CNN Fear and Greed Index are heavily skewed. Investors are acting out of extreme greed, mostly driven by the fear of missing out on the next big tech surge. But as objective, data-driven investors trying to protect and actually grow our portfolios, we literally cannot afford to just blindly follow the herd. We need to look at the math. Which brings us to number 2, the great market narrowing. Let's pull back the curtain on the market's intense concentration to find those hidden clues of structural instability. Over the past decade, the S&P 500 has completely transformed. Today, just 10 stocks command roughly 41% of the index's total weight, yet they only generate about 32% of its earnings. What that means is market value concentration has significantly run ahead of fundamental profitability. To put that into perspective, when you compare the standard market cap-weighted S&P 500 to an equal-weighted version, the cap-weighted index is trading at a massive 30% premium. That is a historic disparity. Moving to number 3, warning signals flashing red. With the market being this incredibly top-heavy, we have to shift our focus to the specific historical warning signs flashing right beneath the surface. Let's talk about the first major warning, the Hindenburg omen. This is a technical indicator designed to measure market breadth. Basically, when it triggers, it signals deep division and a total lack of unity within the stock market. It means plenty of stocks are actually hitting new lows, while the index itself might be hitting new highs. Now, this is a very rare signal, but it is absolutely crucial because it correctly preceded the 1987 and 2008 market crashes. And importantly for your portfolio, it has just triggered again. Now think about this single digit, 3. This represents the Buffett indicator, which measures total market capitalization to GDP. It essentially tells us if the stock market is overvalued compared to the actual economic output of the entire country. Well, this indicator has only hit its current extreme valuation level exactly 3 times in the past 60 years. Valuations matter, folks, and right now they are stretched to absolute historic extremes. Here is another striking metric for you. 625. That is the record number of days the U.S. Treasury yield curve has been inverted, completely surpassing the previous record set way back in 1978. An inverted yield curve, which is where short-term bond yields surpass long-term bond yields, is historically one of the single most reliable signals of potential economic turbulence and a recession ahead. So let's quickly review these flashing red signals together. We've got extreme valuations, like we saw with the Buffett indicator. We have collapsing market breadth, signaled by the Hindenburg omen. We have record cash hoarding. Even Warren Buffett himself is sitting on massive amounts of cash right now. And we have an unprecedented, historically inverted yield curve. These are multiple, completely independent forensic clues that are simultaneously pointing to deep market vulnerability. The really crucial point here is summarized perfectly by this quote from our sources. No single indicator reliably predicts inflection points, but when 8 distinct warning signals align, the probability distribution has materially shifted.
As serious investors, we know for a fact that perfect market timing is impossible. But when we see the convergence of all these signals, it demands our absolute undivided attention. All right, number 4, dot-com bubble comparisons. To be truly objective here, we've got to evaluate how today's market stacks up against historical echoes, specifically the late 1990s. So are we repeating the year 2000? The short answer is no. It really is different this time, but that definitely doesn't mean it's risk-free. If we objectively contrast the completely profitless speculation of the dot-com era with today's Magnificent Seven, we actually see genuine strength today. Back in 1999, you had companies with literally zero revenue trading at astronomical valuations based on nothing but website clicks. Today, it's a completely different story. Companies like NVIDIA are generating over $60 billion in annual revenue with massive margins exceeding 50%. These are highly profitable businesses with absolute fortress balance sheets. The risk today isn't necessarily a lack of earnings, right? The real risk is the extreme concentration of those earnings. Which leads us to number 5, the Fed put factor. If valuations are so extreme, why hasn't the market corrected yet? Well, here is the powerful external force keeping things afloat. Let's demystify this piece of Wall Street jargon for a second. A Fed put refers to the Federal Reserve's habit of intervening through monetary policy and liquidity injections, basically whenever the market faces a catastrophic decline. Just like a put option protects an investor from a stock dropping, the Fed put is this widespread belief that the central bank will step in and protect the entire market from dropping. And when investors just naturally expect that safety net to be there, it drives them to take much riskier, highly speculative bets. You can literally trace the historical echo of the Fed put over the decades. In 1987, right after Black Monday, the Fed slashed rates and injected liquidity. In 2008, during the financial crisis, they dropped rates to zero. In 2020, during the COVID-19 crash, they unleashed massive quantitative easing measures. History shows us over and over that central banks consistently step in. Now, this powerful monetary tailwind can extend rallies far beyond what fundamentals suggest, sometimes for years. But relying on it, that is a very dangerous game. Finally, number 6, positioning in concentrated markets. How do, as a serious investor, actually synthesize all this conflicting data? How do we position ourselves for a wider range of outcomes? Well, if the risk is extreme concentration, your strategy must be true diversification away from just those top 5 tech names. If the risk is valuation extremes, your strategy should really focus on high-quality growth. That means prioritizing companies with 10+ years of incredibly consistent earnings and free cash flow generation, not just whatever the latest AI hype is. And if the risk is global monetary easing and dollar weakness, history strongly suggests anchoring a portion of your portfolio in precious metals like gold and silver, which act as stores of real value. The goal here isn't to perfectly time the crash, it's to position your portfolio to manage risk and weather whatever comes next. I'll leave you with this provocative final thought. Invest in real value before the next bubble pops. Look, when the tech giants are masking a narrow market, and the yield curve and the Hindenburg omen are flashing red all at once, the ultimate question isn't if the market will shift, but how well your portfolio is anchored when it finally does. Take a really hard look at your investments today. Are they built on genuine long-term fundamental quality, or are you just riding the momentum of the Magnificent Seven? Thank you so much for joining us for this explainer, and remember, always keep questioning the data.